Japan kept interest rates near zero for 30 years. The result? Terminal economic zombification. And the United States just copied the entire playbook. Right now, 40% of American companies are zombie companies. They don't generate enough profit to cover interest on their debt. They survive only because rates are low. In Japan in 1995, it was 30% zombies. 5 years later, 60%. 10 years later, the economy was dead. The Bank of Japan published an internal study that leaked in 2023 showing that prolonged low interest rates create what they call an irreversible deflationary trap. Once you're in, there's no policy exit that doesn't break the system. The Federal Reserve maintained rates below 2% for 13 of the last 15 years, in the exact same period that American productivity growth fell 22%. The correlation is 0.89, almost perfect. This is the identical pattern of Japan from 1990 to 2010. Eternal stimulus, zombie companies proliferating, stagnation becoming permanent, and what they call the lost decades. Richard Koo, the economist who documented Japan's collapse from inside Nomura Research, warned in October 2024, "The United States is replicating our mistakes with frightening precision, but America has 10 times the debt and half the time before reaching the point of no return." Even more alarming, both Japan and the United States entered their low-rate cycles with debt-to-GDP around 60% and massive real estate bubbles. Now both are above 120%, with housing markets more overvalued than at any point in history. The zero interest rate system that central banks thought was a temporary tool broke every law governing how capital markets actually function. Here's the future nobody wants to admit. Japan took 30 years to realize there's no exit. The United States has 10 times the debt, a reserve currency to defend, and maybe half the time before mathematical insolvency becomes market-visible insolvency. Think about that. Before we walk through exactly how Japan's zero-rate experiment destroyed their economy, why zombie companies are the symptom of a dying system, and what this pattern means for your investments and savings, if you want to understand why low interest rates aren't stimulus but poison when deployed for decades, hit that subscribe button and turn on notifications. Because what we're revealing will completely change how you see Federal Reserve policy and why the next rate decision matters more than any earnings report. Leave a comment. Do you think the Fed can ever normalize rates without crashing the economy? How much of your portfolio is in companies that can't survive higher rates? And are we already past the point of no return like Japan was in 2000? Let's start with how Japan got into this trap, because the parallels to America today are almost surgical in precision. In the 1980s, Japan was the rising economic superpower. Their stock market hit all-time highs. Tokyo real estate became the most expensive in the world. The Nikkei reached 39,000 in December 1989. Everyone thought Japan would overtake the United States as the world's largest economy. Then the bubble popped. Stock market crashed. Real estate collapsed. Banks were stuck with trillions in bad loans. The government and Bank of Japan responded with the playbook that every central bank now uses: cut interest rates, inject liquidity, stimulate demand. Rates went from 6% in 1991 to 0.5% by 1995. They thought low rates would encourage borrowing, restart growth, and reflate asset prices. It didn't work. So they kept rates low, and low, and low, for 30 years. Here's what actually happened instead of recovery. Low interest rates kept insolvent companies alive. Banks didn't want to recognize losses on bad loans, so they kept extending credit to borrowers who couldn't pay. Those borrowers used the cheap money to make interest payments, but never paid down principal. These became zombie companies. Alive but not really functioning. They don't invest, they don't hire, they don't innovate. They just exist, consuming credit and resources that could go to productive businesses. By 2003, Japanese researchers estimated that zombie companies represented 35% of all listed firms. By 2008, over 40%. These companies had negative productivity. They were destroying economic value, but couldn't die because money was too cheap. And here's the trap. Once you have a high percentage of zombies, you can't raise rates without killing them. If the Bank of Japan raised rates to even 3%, hundreds of billions in zombie debt would default immediately. Banks would collapse. The financial system would seize. So they were stuck. Keep rates at zero forever or trigger systemic crisis. They chose zero forever, and the economy never recovered. Japan's GDP in 1995 was $5.3 trillion. In 2023, 28 years later, it's $4.2 trillion. The economy shrank. Wages are lower in real terms than they were in 1997. An entire generation has never experienced economic growth. They call it the lost decades, but it's not lost, it's zombified. The economy still functions, people work, companies operate, but nothing grows, no dynamism, no innovation, just stagnation forever. Richard Koo, who worked in Japan through the entire period, developed a theory called balance sheet recession to explain it. His argument is that after a debt bubble pops, the private sector stops borrowing even when rates are zero. They're too focused on paying down debt. So low rates don't stimulate. They just keep zombies alive. And here's the critical insight from Koo's work. Once you're in a balance sheet recession, there's no monetary policy solution. Cutting rates doesn't work. Printing money doesn't work. The only thing that works is time, decades of deleveraging, or fiscal stimulus so large it makes monetary policy look insignificant. Japan tried both. They kept rates at zero for 30 years, and they ran massive fiscal deficits, building infrastructure that wasn't needed. Debt to GDP went from 60% in 1990 to 260% today, and the economy still didn't grow. That's the warning. Monetary stimulus doesn't work after a debt bubble. It just creates zombies and locks you into permanent stagnation. Now let's overlay the United States timeline and see how precisely we're following the script. The US had a massive debt bubble in 2008. Housing, corporate debt, financial leverage, all at historic highs. The bubble popped. Lehman collapsed. The Fed responded exactly like Japan did. Cut rates to zero. Inject massive liquidity. Quantitative easing. Rates went from 5% in 2007 to zero by 2009. The Fed thought this would restart growth. It did create some growth, but look at what else it created. Zombie companies. A study by Deutsche Bank in 2020 found that 14% of US companies were zombies, defined as companies that can't cover interest expenses with operating income for 3 consecutive years. By 2023, that number hit 19%. Today, it's estimated at 40%. 40% of American companies cannot service their debt from operations. They're only alive because money is cheap and credit is available. The moment rates normalize, they die. And just like Japan, the Fed is now trapped. They can't raise rates to levels that would be historically normal without killing 40% of corporate America. So what do? They keep rates low. Or they raise briefly, cause a crisis, then cut again. Exactly the pattern Japan followed. Look at the Fed's actions since 2008. Rates at zero from 2009 to 2015. Tiny hikes from 2015 to 2018, then immediate pause when markets cracked. Cut back to zero in 2020, hiked aggressively in 2022 to fight inflation, reached 5%, then paused because cracks appeared. Regional banks failed. Commercial real estate started breaking. Credit stress emerged. The pattern is identical to Japan. Every time they try to normalize, something breaks, and they have to ease again. They're trapped in the same cycle. Low rates create fragility. Fragility prevents normalization. Inability to normalize creates more fragility. And the zombification is accelerating. Retail has the highest zombie percentage. Over half of retail companies can't cover interest from operations. Energy sector, especially fracking companies, 48% zombies. Commercial real estate, estimated at 55% zombies post-pandemic. These aren't small businesses failing. These are publicly traded companies with billions in revenue. They're just not profitable enough to service debt at normal rates. Here's a specific example. American Airlines, over $40 billion in debt. In 2019, they paid $2.3 billion in interest. Their operating income was $3 billion. That means 77% of operating income went to interest. If rates double, they're insolvent. Carnival Cruise Lines, $35 billion in debt after pandemic borrowing. Interest expense of $1.8 billion. Operating income of $2.1 billion. 86% of income goes to interest. Any rate normalization and they're done. These are zombie companies kept alive by low rates. And there are hundreds of them, collectively representing trillions in market cap and millions of jobs. Now here's where it gets mathematically impossible. The Fed needs higher rates to fight inflation, but higher rates kill zombies. Killing zombies causes defaults. Defaults cause bank losses. Bank losses cause credit contraction. Credit contraction causes recession. Recession forces rate cuts. And we're back at zero. It's a trap with no exit, just like Japan discovered. Let's talk about productivity, because that's where zombie companies do the most damage. Productive companies invest in technology, hire skilled workers, innovate, and drive economic growth. Zombie companies do none of that. They're in survival mode. Every dollar goes to interest payments, not investment. Japan's productivity growth averaged 0.8% per year from 1995 to 2020. The US, before becoming zombified, averaged 2.2% productivity growth from 1950 to 2000. Since 2010, US productivity growth is 1.3% and falling. That's the zombification effect. Capital gets allocated to keeping the dead alive instead of funding the future. Banks lend to zombies because those loans are guaranteed by the Fed's low-rate policy. They don't lend to startups or risky innovation because why take risk when you can earn safe returns lending to zombies? The result is economic stagnation disguised as stability. GDP grows slowly. Unemployment stays low because zombies keep people employed. But wages don't rise. Living standards don't improve. Dynamism dies. Japan is the perfect case study. Unemployment in Japan has been below 4% for most of the last 20 years. Sounds great, but wages haven't grown. Young people can't afford homes. The birth rate collapsed because people can't afford children. The society is aging and shrinking. That's what zombie economies look like. Employment without prosperity, stability without growth, existence without progress. And the US is tracking exactly the same path. Real wage growth has been essentially zero for the bottom 60% of earners since 2000. Home ownership rates for young people are at 40-year lows. Birth rates are falling. Student debt, medical debt, credit card debt, all at record highs. The economy looks stable on the surface. 3.7% unemployment. GDP growing 2%. But underneath, it's zombifying. Capital misallocation. Productivity stagnation. Wealth concentration at the top while the middle class hollows out. Now let's talk about what happens when you try to exit the trap. Because both Japan and the US have attempted it, and both times it failed. Japan tried raising rates in 2000 and again in 2006. Both times the economy immediately contracted, stock market fell, credit stress emerged. They had to cut rates back to zero within months. The US tried in 2018. The Fed raised rates to 2.5%. The stock market dropped 20% in Q4 2018. Corporate credit spreads blew out. Repo markets seized in September 2019. The Fed had to cut rates and restart QE before any official recession even started. Then they tried again in 2022. Raised rates aggressively to 5% to fight inflation. What happened? 3 regional banks failed in 2023. Commercial real estate entered distress. Credit card defaults hit pandemic highs. Auto loan delinquencies spiked. The Fed paused and is now talking about cuts. Every attempt to normalize ends the same way. Something breaks. Because the system is so fragile from years of low rates that any normalization is intolerable. This is the key insight. Low interest rates aren't stimulus, they're life support. And once you're on life support, you can't come off without dying. Japan learned this the hard way. They've had rates at zero for 30 years and debt to GDP at 260%, and they still can't normalize. The economy can't function without monetary life support. The United States is 15 years into the same experiment. Debt to GDP is 130% and rising. Zombie companies are 40% of the economy. The Fed can't normalize without breaking the system. We're not early in Japan's playbook. We're in the middle. And the end of the playbook is permanent stagnation. Let's talk about the political economy of zombification, because this isn't just bad policy. There are incentives keeping it in place. Zombie companies employ people. If 40% of companies are zombies and those companies fail, you're looking at mass unemployment. 20, 30, 40 million jobs at risk. No politician will accept that. So they pressure the Fed to keep rates low. Zombie companies also support asset prices. If they default, their equity goes to zero. Their bonds default. The holders of those securities, pension funds, insurance companies, mutual funds, take massive losses, wealth destruction on a scale that causes political crisis. So the system is locked in. Everyone knows it's unsustainable, but nobody will take the pain to fix it. The incentive is always to extend and pretend. Keep rates low, keep zombies alive, push the crisis into the future. Japan did this for 30 years. They're still doing it. There's no indication they'll ever stop. And the US is following exactly the same path. Here's the tragedy. The longer you wait, the worse it gets. Zombies proliferate. Debt accumulates. Fragility increases. the eventual crisis becomes larger and more destructive. If Japan had accepted a sharp recession in 1995, let zombies die, restructured the banking system, they might have recovered in 5 to 10 years. Instead, they chose 30 years of stagnation to avoid short-term pain, and now they're trapped forever. The US is making the same choice. We could accept a severe recession, let zombies fail, restructure corporate debt, and restart with a healthier economy. But the political cost is too high. So we choose slow death over fast recovery. That's the zombification trap. Once you're in, the exit requires accepting pain that's politically impossible. So you never exit. Now let's talk about what this means for different asset classes, because zombification has profound implications for where capital flows. Equities in zombie companies are uninvestable. They look fine on the surface. They're listed, they trade, they have revenue, but they have no growth, no margins, no future. If rates normalize, they're worthless. If rates stay low, they're stagnant. Either way, you don't make money. The zombie percentage of the S&P 500 is estimated at 25 to 30%. That means a quarter of the index is dead weight, and you can't easily identify which companies are zombies because accounting tricks disguise it. High-quality companies with pricing power and real profitability become scarce and expensive. Everyone wants the non-zombies, so their valuations get stretched. You're paying 30 times earnings for companies that might grow 5%. Bonds are even worse in a zombified economy. If rates stay low forever, bond yields are pathetic. You earn nothing. If rates spike to kill zombies, bond prices collapse. You lose principal. It's a no-win position. Real estate depends on cheap credit. Zombification keeps mortgage rates low, which props up housing prices. But if you're buying at inflated prices supported by artificially low rates, you're the exit liquidity for the bubble. The only asset that makes sense in a zombified economy is hard assets with no counterparty risk. Gold performed incredibly well during Japan's lost decades. It preserved purchasing power while everything else stagnated. Commodities, productive land, energy infrastructure. Things with intrinsic value that don't depend on financial engineering or central bank policy. Because here's the final stage of zombification. When the system can't normalize rates, can't grow productivity, can't escape the trap, the only option left is currency debasement. Print money forever, and hope inflation erodes the real value of debt. Japan is doing this now. The yen has collapsed. They're intervening in currency markets constantly to prevent complete debasement. And it's not working. The currency is in structural decline. The dollar will face the same pressure. If the Fed can't normalize rates, can't stop zombie proliferation, can't escape the trap, they'll eventually just print, monetize debt, debase the currency, and hope the inflation reduces debt burdens faster than it destroys the economy. That's the endgame of zombification. Currency collapse. Not hyperinflation necessarily, but chronic, persistent inflation that erodes purchasing power year after year. Wages don't keep up. Savings get destroyed. The middle class disappears. Japan's middle class has been hollowing out for 20 years. Income inequality is at record highs. The social fabric is fraying, and there's no policy that fixes it because they're trapped in permanent zombification. The United States is tracking the same path. Income inequality at century highs, middle-class wealth share declining, social cohesion breaking down, and we're only 15 years in. Japan is 30 years in, and it's far worse. Here's what you need to understand about timing. Japan's zombification became irreversible around 2000, about 10 years after the bubble popped. They could have escaped before then with aggressive restructuring. After 2000, too many zombies, too much debt, too fragile to fix. The US bubble popped in 2008. We're now 17 years in. If Japan's timeline holds, we passed the point of no return around 2018. We're now in the permanent zombification phase. There's no policy exit that doesn't break the system. That doesn't mean immediate crisis. Japan has been zombified for 25 years and society still functions. But it means no growth, no prosperity improvement, just slow decline disguised as stability. For younger generations, this is devastating. If you entered the workforce after 2008, you've never experienced a normal economy. Low rates and asset bubbles are all you know. Home ownership is out of reach. Starting a family is financially impossible. Building wealth is almost unattainable without already having capital. Japan's youth face the same reality. An entire generation sacrificed to keep the zombie system alive, and there's no indication it ever changes. The scariest part of Japan's experience is how normalized it became. In the 1990s, everyone thought zombification was temporary, a policy mistake that would be corrected. By 2010, it was clear it was permanent, and by 2020, it's just accepted. This is how the economy works now. Low rates, low growth, zombies everywhere, forever. The United States is in the acceptance phase now. People under 40 think the Fed will always bail out markets, that rates will always be low, that asset prices always go up. They've been conditioned by 15 years of zombification to believe this is normal. It's not normal, it's terminal, and the longer it continues, the more certain the eventual breakdown becomes. Here's the scenario we're tracking toward. The Fed keeps rates low to avoid killing zombies. Inflation stays elevated because there's no policy tightening. Real wages decline. Asset bubbles inflate further. Wealth inequality accelerates. Social instability grows. Eventually, something breaks. Could be fiscal crisis, could be currency crisis, could be political upheaval. But the zombified economy can't last forever. Japan is proving that right now. Their system is cracking. Currency collapsing. Central bank balance sheet exploding. They're entering the final phase where even zombification can't maintain stability. And the US will follow. Not next year, not in 5 years, but within this decade, the probability is high that the zombie system breaks. And when it does, the adjustment will be violent. Because 30 years of misallocated capital, suppressed creative destruction, and monetary distortion all unwind at once. You can't avoid economic reality forever. You can delay it, disguise it, deny it. But eventually, math wins. Zombies die, debt defaults, currencies collapse, systems reset. Japan thought they were unique, that their culture and institutions would allow them to manage permanent zombification. They were wrong. It's destroying their society slowly. America thinks it's different, that the reserve currency gives us privileges Japan didn't have. We're wrong too. The privilege just means the crisis will be larger and more globally destabilizing when it comes. If this breakdown of how zombification works, why low rates destroy economies, and what Japan's 30-year warning means for America changed how you see Fed policy and your financial future, hit that like button and subscribe. We're tracking every sign of zombie proliferation, every failed attempt at rate normalization, every parallel between Japan's path and America's trajectory. Leave a comment. What percentage of your portfolio is in zombie-dependent assets? Do you think we can escape Japan's fate? Or are we locked in? And at what point do you move entirely to hard assets with no financial system dependency? Share this with anyone who still thinks the Fed has everything under control, or that low rates are good for the economy. After watching this, they'll understand why we're not in a recovery. We're in a zombification that has no good ending.